Hi guys, welcome to my channel Learn with AT. Today we will net assets value concept in hedge fund. Net asset value or NAV is a fundamental concept in the world of hedge funds. It represents the total value of a fund's assets minus its liabilities. Think of it like calculating your net worth. NAV works the same way for hedge funds. NAV provides a snapshot of the fund's value at a specific point in time. Investors need this information to track their investments. Hedge fund managers typically charge a percentage of the NAV as a management fee. The first step in the NAV process is trade capture. This involves accurately recording all the trades made by the hedge fund. Imagine a hedge fund manager buys 10,000 shares of Apple stock. The trade capture team records the date, time, security, quantity, and price. This information is crucial for calculating the fund's NAV. Accurate documentation is paramount. Mistakes can have a ripple effect throughout the NAV process. Many hedge funds use sophisticated systems to capture trade data. These systems reduce the risk of human error. Incorrect trade capture can lead to an understated NAV. Investors would then have an inaccurate picture of the fund's value. This highlights the need for a robust trade capture process. Once trades are captured, the next step is trade allocation. This involves assigning each trade to the appropriate portfolio. Hedge funds often manage multiple portfolios for different clients or investment strategies. It's essential to allocate trades accurately to ensure that each portfolio's NAV is calculated correctly. Think of it like sorting mail. Each piece of mail needs to be delivered to the correct address. Similarly, each trade needs to be allocated to the correct portfolio. This process can be complex, especially for hedge funds that make a large volume of trades. For example, imagine a hedge fund manages two portfolios, a long-only portfolio and a long-short portfolio. The long-only portfolio only invests in stocks that are expected to increase in value. The long-short portfolio takes both long and short positions, aiming to profit from both rising and falling markets. If a trade for Apple stock is mistakenly allocated to the long-only portfolio instead of the long-short portfolio, it could result in an inaccurate NAV for both portfolios. Once trades are booked and allocated in system reconciliation is a critical step in the NAV process. This involves comparing the hedge fund's internal records with external records from brokers, custodians, and other third parties. The goal is to ensure that all trades and transactions are accounted for and that there are no discrepancies. Think of it like balancing your checkbook. You compare your own records of checks written and deposits made with the bank's records. If there are any differences, you need to reconcile them. For example, if the hedge fund's records show a purchase of 1,000 shares of Apple stock, but the broker's records show a purchase of 1,100 shares, this discrepancy needs to be investigated and resolved. Reconciliation helps to identify errors, omissions, and potential fraud. Next step is to do valuation. Valuation is the process of determining the fair market value of the hedge fund's assets and liabilities. This is crucial for calculating an accurate NAV. For publicly traded securities like stocks and bonds, the valuation is relatively straightforward. The market value is readily available from stock exchanges. However, valuing less liquid assets such as private equity investments, real estate, and derivatives can be more challenging. These assets may not have a readily available market price. Hedge funds may need to use valuation models and rely on expert judgment to determine their fair value. For instance, imagine a hedge fund invests in a private company that is not publicly traded. Determining the fair value of this investment requires assessing the company's financial statements, growth prospects, and comparable company valuations. Figuring out the accruals and expenses. Hedge funds incur various expenses in their operations, such as management fees, performance fees, trading commissions, and administrative costs. Expense accrual involves recording and allocating these expenses to the appropriate accounting periods. Management fees are typically calculated as a percentage of the fund's NAV. Performance fees are earned when the fund generates returns above a certain benchmark. Accurately recording and allocating these expenses is essential for calculating an accurate NAV. For instance, if a hedge fund has $100 million in assets and charges a 2% management fee, the annual management fee would be $2 million. This expense needs to be accrued evenly throughout the year and reflected in the fund's NAV calculation.